Welcome back to Today Assets Report, the channel where we cut through the noise and bring you the institutional signals that actually matter before the rest of the market catches on. I'm glad you're here today because what we're about to break down is one of those stories that looks quiet on the surface, but underneath, it is absolutely massive. 3 days ago, Swift made an announcement that most retail investors completely scrolled past. They didn't stop. They didn't click. They moved on. And that right there might be one of the most expensive mistakes a crypto holder makes in 2025. Because what Swift just announced is not a pilot program. It is not a sandbox experiment. It is not another press release full of promises. Swift said their blockchain-based shared ledger has officially cleared the design phase and is now moving into its first MVP iteration, with real-world live transactions going live this year. Let that sink in for a second. Swift, the network that moves between $5 and $7 trillion every single day, is putting a blockchain ledger into production. That is not a crypto number. That is the number that runs the entire global banking system. Correspondent banks, central clearing, cross-border corporate transfers. Swift is the plumbing underneath almost every major financial transaction on this planet. And they just said blockchain is no longer a concept for them. It is now live infrastructure. Now here is where things get interesting, and I want you to stay with me closely because this is the part that most people missed entirely. Swift's announcement was detailed. They listed everything the new ledger would do: tokenized deposits, 24/7 cross-border payments, multi-network settlement options, faster execution, better liquidity visibility, reduced reconciliation. They listed the technology stack, EVM-compatible architecture, Hyperledger BSU as the foundation, designed to integrate with the broader digital asset ecosystem. They listed the partner banks involved in building it, a global group of major institutions. But there was one name that announcement never said. Not once. Not in the press release. Not in the technical documentation. Not in a single quoted line from any Swift executive. And that name, the one that was never mentioned, happens to be the asset that one company has spent over a decade positioning as the exact solution for cross-border liquidity and correspondent banking settlement. The name Swift never said is XRP. And I want you to ask yourself something before we go any further. When a $5 trillion a day payment network builds a blockchain ledger and refuses to name a specific asset, does that mean the asset is not connected? Or does it mean they simply do not need to say it out loud? Let's get into the technical side of this, because this is where it becomes genuinely difficult to dismiss. Swift's new ledger is built on Hyperledger BSU, an open-source, Ethereum virtual machine-compatible framework. Their stated goal is to create infrastructure that can interoperate with existing and emerging networks, record and settle tokenized value, and support multiple settlement options. Now pay attention to that language. Interoperate. Multiple networks. Bridge existing infrastructure. That is not marketing language. That is engineering language. And it lines up with something that most people in the XRP community have never fully connected. Ripple has been contributing code to the Hyperledger ecosystem since 2021. Specifically, they contributed Hyperledger Quilt, an implementation of the Interledger protocol designed to connect the XRP ledger with Ethereum-based blockchains. Blockchains exactly like BSU. And then there is Hyperledger Cacti, a plug-and-play connectivity toolkit that acts as a universal translator between distributed ledger systems. No merging required. No native integration required. Just clean, active translation between networks. Both BSU and the XRP ledger already communicate through that same Cacti layer, which means the XRP ledger does not need to be named in Swift's announcement to already be technically wired into it. The silence in that announcement is not the absence of XRP. It may actually be the presence of something institutional investors understand very well: plausible deniability. Now I want to show you something that I genuinely do not think is being discussed clearly enough right now. And it is the thing that changed how I personally see this entire situation. In the last 90 days, four completely separate institutional signals have converged around XRP and Ripple. Each one individually is interesting. Together, they form a pattern that I do not believe is coincidence. And I want you to see the full picture before you make any decisions. Signal 1. Swift announces a live blockchain MVP built on infrastructure that has direct technical bridges to the XRP ledger through Hyperledger Cacti, and Ripple's own interledger protocol contributions. Signal 2, the DTCC, the institution that clears and settles trillions in U.S. securities every single year, appointed 4 new members to its board of directors. One of those members came directly from Citadel. Signal 3, in November of 2025, just 4 months before that board appointment, Citadel co-led a $500 million strategic investment into Ripple. Not a passive allocation, a strategic investment, the kind that comes with relationships, access, and inside understanding of exactly where an asset is going. Signal 4, the DTCC subsidiary NSCC has now listed Ripple Prime, Ripple's own prime brokerage service, as a participant in their clearing architecture. Let that land for a moment. Ripple's infrastructure is now plugged directly into the DTCC's risk management stack. Swift, DTCC, Citadel, Ripple Prime inside NSCC. For signals, 90 days. Before we go deeper into what that pattern actually means, I need to make sure you understand what the DTCC really is, because most retail investors have no idea what this institution actually controls. The DTCC does not just clear trades. It clears approximately $2.5 quadrillion in securities transactions every single year. That is not a typo. $2.5 quadrillion in annual settlement volume, making it the single largest post-trade infrastructure operator on the planet. Now here is the part that should absolutely stop you in your tracks. The DTCC has already filed patents that explicitly name XRP and XLM as digital liquidity tokens inside a cross-ledger liquidity framework. That patent was not filed by Ripple. It was filed by the DTCC themselves. They used the name XRP in their own intellectual property filing, in their own vision of how future settlement infrastructure works. And now, a Citadel executive from the same firm that made a $500 million strategic investment into Ripple 4 months earlier is sitting at the governance table of that same institution. You can call that a coincidence. You are allowed to do that. But you should at least know that is what you are calling it when you have all of this in front of you at the same time. Here is what the data on the XRP ledger says is already happening on-chain while all of that governance positioning was taking place. At the start of 2025, the XRP ledger held approximately $24 to $25 million in tokenized real-world assets. By the end of 2025, that figure had climbed to $568 million. That is a 2,200% increase in a single calendar year, in a market environment that was not even friendly to risk assets in the second half of the year. Then in January 2026, that number climbed further to $337 million. It peaked near $482 million in mid-February before a pullback brought it back to approximately $408 million in distributed tokenized value. That currently ranks the XRP ledger 8th globally in that category. But the number I really want you to hold is this one. One firm alone, ARK, currently has $1 billion in tokenized assets in its pipeline targeting the XRP ledger. Not deployed yet. Pipeline, waiting to go on-chain. Analysts tracking this space currently project the XRP ledger could reach $3 to $6 billion in tokenized real-world assets by late 2026 if current momentum holds. And that projection does not even include what happens when the regulatory gates fully open. Let me show you what that 2,200% growth actually looks like in composition, because the type of capital flowing in matters just as much as the volume. When you break down what is currently sitting on the XRP ledger as tokenized real-world assets, the single largest category is U.S. Treasury debt. $282 million of the current total is parked in tokenized Treasury instruments. Think about what that means for a second. That is not retail speculation money. That is not crypto-native capital looking for yield. That is institutional capital, conservative, risk-managed, compliance-approved institutional capital, sitting on the XRP ledger in the form of the most vanilla, boring, safe asset class in all of traditional finance. Institutions do not tokenize U.S. Treasuries on a network they have no confidence in. That is not how Treasury management works. That is not how risk committees approve things. The fact that $282 million in tokenized treasuries exists on the XRP ledger right now tells you more about institutional conviction than any press release ever could. Because institutions do not make those moves publicly. They make them quietly, and you see it later in the data. Now here is a part that almost never gets mentioned in XRP coverage, and it is actually a critical piece of the real picture. If you include stablecoins alongside the real-world asset figure, the XRP ledger's total tokenized value is already above $821 million. The headline number you see reported most often, the $400 million figure, is technically accurate and simultaneously deeply misleading to anyone who does not read past the first line of the report. The real number, when you count everything properly, is closer to $821 million. And it was growing at a pace that would have put it well above $1 billion before the broader market pulled back. This distinction matters because the narrative around XRP's adoption is constantly being framed around the price chart instead of the infrastructure chart. And those two charts tell completely different stories right now. The price chart shows frustration. The infrastructure chart shows acceleration. And historically, in every major institutional adoption story across every asset class, the infrastructure chart leads. The price chart follows. Always. Every time. The question is never if. The question is only when. Here is a name I want to introduce to you, because it connects the Swift announcement directly to real-world operational flow in a way that most XRP analysis completely skips over. The name is EastNets. EastNets built a product called Payment Safe, a payment hub that connects domestic networks, international rails, and the Swift network into a single unified gateway. One of its core components is a universal translator for payment formats, specifically designed to bridge legacy MT messaging with the new ISO E20022 standard, including CBPR Plus for cross-border interoperability. This product is not theoretical. It is live. It is in production. It is processing real Swift traffic right now. And it is built to handle XRP as a settlement rail alongside traditional payment formats. Now connect that to what Swift's new ledger is designed to do: tokenized deposits, 24/7 cross-border settlement, multi-network interoperability. And then connect that to the fact that several of the banks Swift brought in as design partners for this new ledger are already active Ripple partners. These are not banks that are evaluating Ripple. These are banks that are already running on Ripple rails, and they are now co-designing the infrastructure layer that Swift will use for live blockchain transactions starting this year. The pattern I keep seeing when I look at all of this together is consistent, and it is deliberate. The institutions are not announcing XRP. They are building around it, quietly, methodically, through partnerships, through board appointments, through patent filings, through tokenization pipelines, and through infrastructure that is technically wired for XRP to flow through without ever using the name in a press release. For the retail investor who has been holding since 2021 and watching every announcement come and go without a sustained price move, I want to be completely direct with you right now. The delay was never in the technology. Ripple's infrastructure has been live, tested, and battle-hardened across hundreds of financial institutions for years. The delay was in governance, regulation, and institutional positioning. And right now, in real time, two of those three are visibly moving. The governance layer is shifting: DTCC board, Citadel strategic investment, Swift design partners that are already Ripple customers. The regulatory layer is the one retail investors keep watching, and that is still moving through the process. But here is what most people get wrong about the sequence. The capital does not wait for the press release. The capital positions before the press release. Always. Here is the truth I think most long-term XRP holders have never had stated plainly enough, and I want to say it clearly right now. You were right about the thesis. The cross-border payment problem is real. The correspondent banking inefficiency is real. The demand for a bridge asset in a multi-chain financial system is real. You identified all of that correctly years ago, and the price still has not reflected it. I personally believe the reason for that gap is not that the thesis was wrong. The reason is that institutional adoption of a new financial rail does not happen in a straight line. It happens in layers. First, the technology gets built. Then the governance gets positioned. Then the regulatory framework catches up. Then, and only then, does the capital flow in a way that moves the price visibly and sustainably. We have been in the first two layers for years. The technology was built. The governance layer is moving right now in real time. The regulatory layer is the one everyone is watching. And when all three align, and I genuinely believe we are closer to that moment than at any point in this asset's history, The move that follows does not tend to give people time to position. It tends to leave behind the people who sold the week before. What Swift is building, what the DTCC is filing patents around, what Citadel strategically invested $500 million into, what Ripple Prime is now embedded inside through NSCC. None of this is happening in isolation. These are not four separate institutions making four unrelated decisions. These are four of the most powerful financial infrastructure operators in the world, all quietly moving toward the same intersection at the same time. And that intersection runs directly through the asset that Swift's announcement refused to name. Retail fatigue, the exhaustion, the frustration, the people who have been right about the thesis for 3 years and are tired of waiting. That fatigue is not a sign the thesis is wrong. Historically, retail fatigue is exactly what creates the accumulation window that institutions depend on. Cheap supply from people who are correct but emotionally worn out. That is not cynical. That is the documented pattern of every major institutional entry into a new asset class going back decades. The XRP holder who has been waiting since 2021 is not wrong about where this is going. They are simply being asked to hold through the most psychologically difficult phase of any investment, the phase where you are right and the market has not confirmed it yet. Let me bring this back to the Swift MVP, because that is the live event on the calendar that everything else connects back to. Swift said real-world transactions on their blockchain ledger are going live in 2025. That means within the current year. That means we are not talking about future infrastructure anymore. We are talking about present infrastructure going into active use. When that happens, when those first live transactions run through Swift's blockchain ledger, watch which assets the partner banks choose to use for cross-border liquidity. Because those partner banks are already Ripple customers. They are already running on XRP rails in their existing operations, and they are now co-building the Swift ledger from the inside. The question Swift's announcement refused to answer, what asset will be used for cross-border settlement on this new ledger, is not going to be answered in another press release. It is going to appear quietly in the transaction data, the way all institutional moves appear, not in the headline, in the numbers that follow. Now I want to give you the specific threshold, the number that tells you institutionally that a decision has already been made, and this is no longer a question of if, but purely a question of when the market prices it in. That number is the moment on-chain real-world asset volume on the XRP ledger crosses $1 billion and holds. Not a spike, not a peak, not a single-day number, a sustained floor above $1 billion in tokenized real-world value. Because at that level, with $282 million already in treasuries, with ARK's pipeline ready to deploy, with Swift's live transactions beginning this year, and with stablecoins already pushing the real combined figure above 800 million, at that point, the infrastructure argument is no longer an argument. It is a fact visible in the data to anyone who looks. And facts visible in data attract capital at a pace that arguments never do. The institutions do not need to believe in XRP. They need to see the data confirm that the infrastructure is real, adopted, and growing. That confirmation is closer today than it has ever been. If you have made it to this point in the video, you already understand something that the majority of crypto investors do not. You understand that the story of XRP is not being told in price action right now. It is being told in patent filings, board appointments, tokenization pipelines, hyperledger contributions, Swift MVP launches, and DTCC clearing integrations. It is being told in the language that institutions use when they are positioning before they announce. And understanding that language, being able to read those signals before they become headlines, is the only real edge that a retail investor ever has. Because by the time it is a headline, the positioning is done. The capital is already in. The move has already started. Today Assets Report exists to make sure you are never the last to know. Subscribe right now and hit the notification bell, because the next signal in this sequence is already forming. Swift goes live with real transactions this year. The Regulatory Clarity Act is still moving. The DTCC board now includes a voice with direct financial ties to Ripple. $1 billion in tokenized assets is sitting in a single firm's pipeline waiting to go on-chain. These are not isolated events. They are a sequence, and sequences, once they reach a certain velocity, accelerate faster than anyone expects. Do not be the person who understood all of this and still missed the moment. Stay with us. We will cover it the second it moves.